And hello to my colleagues in Finance or MBA 502. And I just want to, and maybe other classes where I may use this, because I use some of these videos in other classes. I just want to, first of all, say happy holidays to everyone. And this is an introduction to Chapter 5. Interest rates are an important concept, so I want to talk about them. First of all, in the beginning of the chapter, they do a very nice job showing you all the notation that is going to be used. Okay. And this one you'll see a lot. Effective annual rate. So, and uh, and then you'll see this one and present value and future value we'll talk about a lot. Um, so we'll get to that. All right. In other chapters, that's an important concept. And annual percentage rate we're going to discuss. Okay. And of course, we'll talk a lot about inflation and net present value. And okay, so basically, in chapter 4, we look. You'll see if you read chapter 4, which I kind of skipped over a little bit, which we're going to talk about later, right? Present and future values. We'll get to that eventually. All right. So interest basically is paid and quoted in the different ways. And you can clearly see if you read this here how they quote it. You'll notice here Capital One offered savings accounts with an annual interest rate of 1.9% paid at the end of each month, while American Express offered an annual interest rate of only 1.44% but paid on a daily basis. So anyway, it all depends on how the bank. You always have to ask banks and credit cards how they credit and interest rates, right? Sometimes you pay on the credit cards, obviously. All right, and sometimes in banks you have to say how often am I going to get it. So you notice here, Capital One and American Express do it different ways. All right, so another interest rate that comes up is the risk-free rate, and it's called risk-free because the government will always pay you back on Treasury bills, right? And that was in 2018, and it's much lower now. They have it as 2.36%. And if you look at 20-year treasuries, it goes higher, right? The reason it goes higher, of course, is you're going out 20 years, so you got more risk. Remember, with more risk, you always should get more return. So you can see here, interest rates can also vary due to risk or tax consequences. The U.S. government is able to borrow at a lower interest rate than Johnson and Johnson, which in turn can borrow at a lower rate than American Airlines. So it all depends on their risk level and their ratings. So what we're going to look at is we're going to consider the factors that affect interest rates, and there's going to be a lot of equations in this chapter, and we're going to determine a lot of the discount rates. So there'll be a lot of equations and a lot of math for different cash flows. So I just want to warn everybody that you got to really read this chapter pretty hard. And we're going to look at how interest rates are paid and quoted, and how to calculate the effective rate in 1 year, given different quoting conventions. All right. And then we'll look at inflation and government policy. And anyway, so that all goes on. Finally, we examine the role of risk in determining interest rates, and so we'll look at risk, of course. All right, so these are all important topics that are going to be in this chapter. That's why I chose to do this chapter early. Okay. All right. So again, interest rates are quoted in a variety of ways. Okay. And the same information, by the way, is in your slides. All right. I made videos, I think, using the slides, but I want to go through the chapters in a little more detail. So that's what I'm doing here. Well, generally stated as an annual rate, okay, and that's important to know. Most times you'll see an annual rate, especially when you have a car or a mortgage rate. The interest payments themselves may occur at different intervals, right? So, on a mortgage or a car, right? The interest payments you're going to basically get are probably daily, from the bank that you owe, right? And if you have a savings account, you may get the monthly or semi-annually or quarterly on your savings accounts. So it's all, again, you got to ask a lot of questions. When evaluating cash flows, however, we must use a discount. And this is an important term, a discount rate. And we want to make sure we compare apples to apples. You notice it says here, matches the time period of our cash flows. This is an extremely important concept, right? We're comparing apples to apples and oranges to oranges. This discount rate should reflect the actual return we could earn over that time period. In this section, we explore the mechanics of interpreting and adjusting the interest rate to determine the correct rate. Okay? So the first thing we got to talk about is the effective annual rate. Okay? And interest rates are often stated as an effective annual rate. And let me click on that. This is the total amount of interest that will be earned at the end of 1 year. So let me make a point. When you put money in your savings account, you get interest. Let's say you get interest on the first quarter, the first 3 months. And then from that gets credited to your account. And then from that point on, you get interest on the original principal plus the interest that was previously earned. So effectively, and this is an important word, effectively, you're getting a higher rate, okay? So I want to make that point, and if anyone is never clear about anything I'm saying, please email me. So you think about how banks credit interest. So you see what it says. This indicates the actual amount of interest that will be earned at the end of 1 year. And there's a little 1 there. I guess they take you to somewhere. This method of quoting the interest rate is the one we have used thus far in this textbook. So chapter 4, we use the effective annual rate as the discount rate in our time value of money calculations. All right. So for example, with an effective annual rate, and you see it right here, of a $100,000 investment. So if you put $100,000 in the bank, after 1 year, of course, at 5%, you're going to have $105,000. This is a very simplified equation. And this is kind of what I was driving at, all right? This is kind of what I was driving at. And so that's after 1 year, all right? After 2 years, now remember you now have 105,000, right? So you'll notice how they square this. You now, instead of having 110,000, you don't get an extra 5,000. You get an extra $250. You get an extra 5,000 added to that on your principal, plus an extra 250, which is the interest on the interest. Okay? So I want to make sure everyone is clear about that. All right. So I'm going to I'll pick this up and I'll add more to this in a bit. So hello, my colleagues, and I'm back, and I want to pick up where I left off. And so we talked about basically effective rates here, right? So this was the 2-year period, and I showed you that you picked up an extra $250. All right, so now what I want to do is I want to go over here, and I want to adjust the discount rate. Okay, so please be advised. There's a difference here. The 5%. In this example, the 5% in this example. Hold on. So in this case, this was an effective rate. Okay. This was an effective rate because they assumed that this was the rate you were going to get for multiple periods within the year. One has to be careful about that, all right? So you see what it says. EAR is the actual amount of interest that will be earned at the end of 1 year. All right, so Now we're going to talk about the discount rate to different time periods. So this example that we just saw showed the effective annual rate of 5% for 2 years is equivalent to earning 10.25 in total interest over the entire period. So how did we get that? You'll notice we got $10,250 on 100,000, right? So that's an effective rate of basically 10.25%. Now that again, that's not annual. That's over the entire period. Okay, that's an important consideration. That's an important consideration. So you'll notice here how they came up with that, and again, they showed you this calculation. So by raising the interest rate factor to the appropriate power, we can compute an equivalent interest rate for a longer time period. So that's kind of what we're doing, right? We're doing it for a longer time period. All right. So because we raised that to the power of 2 in this case. So we can do the same thing to find the equivalent interest rate for periods shorter than 1 year. In this case, we raise the interest rate factor, 1 plus r, to the appropriate. Now we're going to use a fractional power, okay? A fractional power. All right? For example, earning 5% interest in 1 year is equivalent to receiving, and you'll notice now I made this 6 months, because we're going to do this for 6 months, okay? So the half is 6 months, so if you earned 5% in 1 year, in 6 months you earn on a dollar, 2.47 cents, okay? For every $1 invested for every half year, or equivalently every 6 months. So as I said, the half is equivalent to 6 months, okay? The half is equivalent to 6 months. So let me highlight that. I made a mistake here. Hold on. We can verify this result, right? But so we can compute the interest rate for the 1 year, and what you'll see is if we take this 6-month period, okay, and that's why this is an effective rate, and we multiply this, squared it, you'll see it'll come out to 1.05 if you go through the math. Okay, and you see it says here that's equal to R for 1 year. All right. So the 6-month rate power raised to the power of 2 gives us that rate. All right. So let me go here, and so let's look at a general equation for what we just did, and the equivalent end period rate is equal to this equation right here. So you can see it's very similar to this, right? And n could be anything we want. In this formula, n could be larger than 1 or smaller than 1. And that's the important consideration here, all right? And let me just make that pink because that's an important point. When computing present or future values, which we'll be doing a lot of, it is convenient to adjust the discount rate to match the time period of the cash flows. Okay? All right, so that's important to know. This adjustment is necessary to basically, when we look at a perpetuity or an annuity, which we're going to get to, all right? A perpetuity is something that goes on forever, which is like the word perpetual, right? It sounds like perpetual. An annuity is something like your pension, that you either put money in a 401k or you collect money from a 401k when you retire. Okay? All right. So I'm gonna pick up this example on the next video. I'm gonna combine the two videos I just made, and they get kind of long. All right.